Hello. Here we are. Okay. How y'all doing? We're back in chapter 9. First thing I want to do today is get through that homework because I want to talk about some real important stuff today. Okay? So let's jump right over to Quick Study 9-1 on page 377. Okay? This is in regards to credit cards. The credit card entries are nested into this chapter. They're not pure receivables, but they are covered in this chapter. Prepare journal entries for the following credit card sales transactions. The company uses the perpetual inventory system. Again, we're on Quick Study 9-1. Okay, number 1, we sold $16,000 of merchandise that cost $7,000 on MasterCard credit cards. The net cash receipts from sales are immediately deposited in the seller's bank account, and there's a 4% fee. Okay? All right. Well, the first thing that we do when we record the sale let me see. Is to record, we have to record 2 entries, okay, because of the perpetual inventory system, okay? All right, we get the cash immediately. Now, we record the sale of $16,000, but we don't get the full cash amount of $16,000, do we? There's a 4% fee. 100% minus 4% is 96%. 96% times the sales of $16,000 is 15360. The credit card expense, thus, is debited for the 4% fee times that $16,000. And, of course, we have to reduce our merchandise inventory account and account for our cost of goods sold, a la chapter 5 and 6, right? Okay? Yeah.
So, I don't know, I was driving home yesterday and I had accounting on my mind for some reason. And
lots of people do, Brian, when they drive. There's no reason to apologize for that.
I was wondering that if, since the credit card companies, charge their 4%, that if the business will actually up their cost of that good, that amount of money to make up for.
Well, that is a good question. I know gas stations used to do that. They used to have a cash price and they used to have a credit card price. Okay, and it's an expectations thing in the sense of if you were going to do that, you wouldn't want to say we're going to charge you more if you use your credit card. What they want to say is we're going to charge you less if you use cash, right? So it's kind of a half full instead of a half empty situation. There have been merchants that do that, and the only thing is you got to be careful because. I'll give you one example. There used to be a gas station that was called the Working Man's Friend. The Working Man's Friend, and it was on 95th near Flum. And I used to live over there. And that gas station, this was in the early 90s, okay? And I used to drive to work there. And the Working Man's Friend gas station, they only took cash. Cash. That's it, okay? And I'm sure the reason they did that was for some of the reasons that you said, okay? They didn't want to pay the fee for credit cards. There was a stoplight right there, and sometimes I would look over, and people would get out of their car, make the move, see that they only had cash, they'd check their cash. They didn't have cash, they'd go to another gas station, right? So in the end, I guess Working Man's Friend benefited because they never had to pay a credit card fee, but in the end, they're not there anymore, okay? And you can't, and today, now of course that was before debit cards were used prominently, but you can't even have a gas station without sliding, having to slide in, pay at the pump, can you? You cannot do that. Why can you not do that? Think about it. Think about where you'll be in about 6 years, maybe. Well, I'll just tell you this. When I was a young boy in Wichita, Kansas, in the early 70s, and my mom would get gas. They didn't have pay at the pump, so what would she do? She'd just leave me sitting in the seat, probably not even a car seat, and she'd just go in the gas station and pay, and I would be out in the car for just 2 minutes, 3 minutes at most by myself as a 2-year-old or 3-year-old. Can you do that stuff these days? No. Back in those days, God bless her, she used to go to the grocery store for 25 minutes and let me and my brother play in the car with our Hot Wheels. You can't do that anymore, can you? So when you have kids, you'll realize the importance of the paying at the pump, because a lot of times your kid will be asleep, or you don't want to take him out of the car seat or whatever. But you know, that's a little off the subject, but not totally. What I'm saying is, in the end, the goal of a business is not to avoid credit card fees. It's to increase your bottom line, right? So you'd have to take those things into account. Okay, good question. Okay, number 2, sold $18,000 of merchandise that cost $7,800 on an assortment of credit cards. Net cash receipts are received 5 days later, and a 3% fee is charged. Okay, this is all the same, except we do not debit cash right here. We debit accounts receivable, not from the customer, but from the credit card company. Okay? And then a few days later, that credit card company sends us the money. And, you know, there's a little less fee for this because there's a little delay. And I don't know how much I don't know how much this is actually done anymore, since there's so much electronic commerce that takes place. Okay? But those are the 2 examples. Okay?
Why would you do the accounts receivable credit card companies, the debit?
Well, because you haven't got your money yet. What you're going to do is you send those off to the credit card company. You don't have your cash. They're going to send you your cash later. Okay? Okay. All right. I want to go real quick through exercise 9.1. It's basically the same thing. But there's some important lecture I want to make sure we have time for today. It's one of those lectures I don't want to have to stop halfway through. Okay? Exercise 9.1. Hugh Company uses the perpetual inventory system and allows customers to use 2 credit cards. With the OmniBank card, they receive an immediate credit to its account when it deposits its sales receipts. Omni assesses a 4% service charge for credit card sales. The second credit card that Hugh accepts is the Continental card. And in that situation, they send their accumulated receipts to Continental on a weekly basis, and they're paid by Continental about a week later. There's a 2.5% charge on those. They want us to do journal entries for this. Okay, on April 8th, sold merchandise for $5,600 that had cost $41.38, and they accept the customer's OmniBank card. The Omni receipts are immediately deposited in the bank account. Okay? So, let me straighten this up for you. Those are the 2 entries there. The rationale is exactly the same. Exactly the same. Okay, I just wanted to have another example of doing this. On April 12th, they sold merchandise for $6,000 that had cost $4,400, and they accepted the customer's Continental card. Transferred $6,000 of credit card receipts to Continental, requesting payment. Okay? So on April 12th, those are the entries. Okay? All right? And then on April 20th, they received the check regarding the April 20th billing from the credit card company. Okay? So that is the answer to that. All right. Okay, you know what? I'm not going to go through exercise 9-2 right now. Okay? Even if we have to wait to do exercise 9-2 until next class period, I think it's more important that I make sure we get through this lecture without having to take a break. Okay? So, remind me, class, that we still need to go through exercise 9-2 at some point. Okay? But I want to hop on over to chapter 9 again, because I want to talk about bad debt expense. Okay? Now, we are not talking, as a reminder, we're shifting back here. You don't need to go to the PowerPoint yet for the television. We are not talking about credit card receivables. We're not talking about credit card anything. Remember, in most instances, when people pay with a credit card, we're good. There's no receivable there unless we have to send it to the credit card company. We're not talking about that situation. We are shifted back to the classic receivable, where I provide a good or service to a customer, and they're going to pay us at a later time. Correct? They are going to pay us cash for something that we've already provided. Now, there will be times that there is something called bad debt expense, when there are people who genuinely owe us money and they do not pay us. Okay? When they owe us money on a receivable and they do not pay us. Going to the PowerPoint now. Why might customers perhaps not pay the amounts that they owe? There's a variety of reasons. Can you think of any? Why may somebody not pay us the money they owe? They may not have it. In this economy, I am sure nobody here does collections, do they? Is anybody here? In this economy, you might call people and they say, hey, I know I owe you $500. You know what? I do not have it. I simply don't have it. You can come over, you can look into my wallet, you can frisk me, you can check under the cushions on my sofa. I don't have $500. I admit I owe it to you, just don't have it. Okay, what's another reason?
Not satisfied with the good of the service.
Maybe they said, you know what? I think what you sold me is a piece of junk. I'm not going to pay you. Or, you know, I owe you $500 for the sprinkler system you installed in my yard. You know what? It doesn't work very good. It's horrible. It's horrible. I'm not going to pay you. What are you going to do, right? Okay, what's another reason somebody may not pay us? They could just be a bad person. I mean, they just could be somebody who just runs up receivables and they don't pay them. Like there's people who write hot checks. It's just the way they live. Okay? What's another reason somebody may not pay? They could be dead. You ever try to collect money from a dead person? They just ignore you, right? But I mean, this happens, right? There are times somebody will owe you money. Well, they're dead, and they're dead. That's happened, okay? There are also times that a business will owe you money, and they've gone bankrupt. They're out of business, right? So there's a variety of times that people may not pay the amount that they owe, and what results is bad debt expense. Okay. Now, I have a question up here that says, when customers don't pay, is that always a bad thing? And sometimes I spend a little bit of time talking about this, and some students will say, because what I'll say is bad debt expense is not always a signal that things are wrong. What do I mean by that? And sometimes students will say, well, if they don't pay on time, maybe you can accrue interest. That's not really what I'm getting at, although that may be true. What I'm saying is this. If I wanted to guarantee that I never had bad debt expense, what could I do?
Incentives.
I don't know if that would guarantee it. If I wanted to 100% guarantee that there would never be a receivable that wasn't paid, cash only. Just like the sign says, in God we trust, all others pay cash. And there are places that accept cash and that's it, right? Garage sales do this a lot of times. You can only pay cash, and not even a check. Of course, in business setting, check is considered cash. Now, however, what if you normally had sales of about $100,000 per month, but about 1,000, and you sold on receivables, but about 1,000 of that wouldn't be collected because it was bad debt expense? Well, would you be better off in a situation where you completely went to everybody must pay cash, but your sales dropped to $60,000 and you had no bad debt expense? Of course not. Do you see what I'm saying? The reason we offer receivables is to increase our bottom line. bad debt expense, we you know, we're not thrilled when customers don't pay us, but it's also, it's part of doing business. I can tell you this. If there were a credit, you think credit card companies ever have people not pay the credit cards that they owe?
Oh, yeah.
Yeah. I would venture to say this. If there was ever a credit card company that had no bad debt expense, to me that would indicate that they were too restrictive on their credit policy. Do you see what I'm saying? What if they made a policy of we only offer credit cards to those who have $1 million net worth or more? Well, that's fine, but you're going to lose a lot of business, aren't you? You do not want to, the purpose of business is to increase your bottom line, not to reduce or eliminate bad debt expense. Lauren.
What are consequences of not paying? Because a lot of things you're saying sounds just like people just don't pay and then that's it. Like, then wouldn't everybody be doing that? Which I guess everybody is because we're the most debted
That's
country.
why when people don't pay you in your business, usually you have somebody that goes out and breaks their thumbs. I'm just kidding. No, you can't do that. Well, they get a bad credit report, but some people's credit is so bad that they're like, mine can't get any worse, right?
It was like the worst, like you can't get an apartment or something like that, or?
Well, it depends. I mean, if it's something that you can repo, like a car, they'll go repo it. They'll put it on the tow truck, they'll take it away. If it's an apartment situation, they could throw you out of the apartment. It really just depends on what it is. If it's a tax bill that you owe.
Oh, I meant like, if you say you
you're in
don't
big
pay,
trouble.
say you don't pay for your like $1,500 new TV,
Yeah.
and so, I mean, they're
Your
not just
credit
gonna
will
come
go
and
bad really quick. And when you need to get credit in the future, perhaps for a car or a home, if you get credit, it could be at a really exorbitant rate. Or you may not be able to get credit at all. So, but there are some people who are like, I don't care. Right? I don't care. There are people who don't really think past today. So, there are consequences. And, you know, we live in a society where it's like everybody's declaring bankruptcy. And, you know, there are some real lasting effects of declaring bankruptcy that will follow you for years. So, but it's kind of a short-term game. Unless you're just going to be a professional con person, you can't live that way very long. Okay? All right. Let's go on. Now, I want you to really pay attention to this little outline that we're going to go through here. Okay? There are two methods of dealing with bad debt expense. Let me get my pointer going. There are two methods to dealing with bad debt expense. We can use the direct method or we can use the allowance method. Okay? Now, if we use what's going to be known as the allowance methods, there are two types of allowance methods. There's the percentage of sales, and then there's the accounts receivable methods. If we use an accounts receivable method, there's actually two of those. Okay? So sometimes it's kind of hard to know in my little lecture here where we are in this thing. So you might want to keep this little organization of our discussion in front of you. Let's talk first about the direct method. For example, on August 4th, Barton determines it cannot collect $350 from Martin Inc., who owes us money, a credit customer. So what do we do? Now, this is the direct write-off method. Well, it's pretty easy. We debit bad debt expense, and we take the receivable off the books. Now, you know from exercise 9.2 that whenever we debit or credit a receivable, we have to debit the main control account or credit the main control account, and we also have to debit or credit the appropriate detail subsidiary account, don't we? Okay? This is pretty easy, isn't it? Okay? And so on August 4th, this is what we would do. Okay? Now, there's one problem with this, and it's kind of a big problem. And we're going to talk about that in just 1 second. But let's say we make this entry, we write off their account under the direct write-off method. A few days later, guess who wanders in? Martin and they want to pay $200 that was previously written off. Do we tell them, hey, your money's not welcome here, we rewrote off your account, buddy? No, take their money. So what we would do is we would actually put back into place or reverse $200 worth of that receivable, and then we would collect the money. We would collect the money as normal, as we normally would. Does this make sense? That is the direct write-off method. But there's a problem with the direct write-off method. Okay, we wrote off this account on August the 4th, right? Now, we no doubt wrote this account off only after we had exerted quite a bit of effort in trying to collect this receivable. Are you with me? Okay? So here's the deal, coming off the PowerPoint and coming to me live. We wrote this account off and had this expense on August the 4th, right? The month of sale where this actually occurred was probably months, if not maybe even a year earlier, wasn't it? So you've got like the sale took place in November of 08 and we're writing it off with an expense in August of 09. That is a violation of the matching principle. Do you remember what the matching principle is? The matching principle states that we want to have expenses recorded in the same period as the revenues that they helped create. And that's being violated, is it not? Because the revenue was recorded in November of 08, the expense was recorded in August of 09. Thus, the direct write-off method, while simple, is a violation of the matching principle. Okay? So what we have to use, and it talks about this on this slide, about the matching principle over here. Okay? So what we have to use is we have to use an allowance method. If we want to follow GAAP, we have to use an allowance method. What is an allowance method? An allowance method states that at the end of each period, we estimate total bad debt expense, okay, to be realized from that period's sales. Now, there are two advantages to this method. First of all, it follows the matching principle. Bad debt expense will be recorded in the same period as the revenues they helped create. Matching principle is followed. The second advantage of this is accounts receivable that's reported on the balance sheet will be reported to the true amount of cash that we believe we will collect. Does this make sense? Let's look at an example. For example, at the end of its first year of operations, Barton Company estimates that 3,000 of its accounts receivable will prove to be uncollectible. The total AR balance at December 3107 is $278,000. Okay, under the allowance method, okay, this is the allowance method, okay? This is the entry that we make when we estimate bad debt expense. We debit bad debt expense and we credit an account called allowance for doubtful accounts. Now, what type of account is this allowance for doubtful accounts? Whenever I introduce a new account, I like to train my students to think, okay, what type of account is it? What financial statement does it go on? And is it a normal debit or normal credit balance account? Are you with me? Well, this is a contra asset account. Now, we've learned about another contra asset account. Does anybody remember what that was? Accumulated depreciation. Now, an asset account is a normal debit balance, correct? Contra means on the other side of. So a contra asset is a normal credit balance account. The asset's a debit, but this is a contra asset, so it's a credit balance account. Okay? So this is the way we estimate bad debt expense. Now, why do we not credit accounts receivable here? Why do we use this allowance account? That's a great question. I'll answer it in a minute. How does this look on the in the T accounts? Well, we have our accounts receivable over here. Now, we did not do anything to that accounts receivable, right? And that accounts receivable, this is the control account. It's backed up by detail, isn't it, of each customer and what they owe us. We credited not AR, but allowance for doubtful accounts. And the way this looks on the balance sheet is like this, kind of like accumulated depreciation is. We have our asset minus our contra asset, and that equals our net amount. Okay? Now, sometimes students get confused the way this slide is. Don't worry about cash here. Don't worry about inventory. They're just showing you a partial balance sheet here. But we have our asset minus our allowance equals our net AR. So this answers the question of why, when we make an estimate of bad debt expense under the allowance method, why we credit allowance for doubtful accounts instead of AR. Does anybody know where I'm going with this? Let's go back to that entry. Because couldn't somebody say, well, Dave, you could still estimate this, but just go ahead and credit AR. Here's the reason we can't do that. Remember when I talked about whenever you debit or credit AR, what do you also have to do? You have to go to the subsidiary detail, don't you? So when we estimate that $3,000 of this accounts receivable will be unpaid, if we credited AR, well, we're making an estimate. Whose account are we going to go reduce for $3,000? Do you see the problem here? Yeah. Do you guess? Do you prorate it? Neither of those methods is good. So there has to be some way of reducing the net AR when we make our estimate of bad debt expense that doesn't involve us reducing individual people's accounts. The way that we do that is by using this allowance account. We credit allowance for doubtful accounts. We do not have to go to anybody's detail and change the amount that they specifically owe us. And yet, on the balance sheet, the net AR is reduced. Do you understand where are you tracking with me? Of why we use that allowance account? We can't credit AR because then we'd have to go to somebody's account. We don't know who's not going to pay us. We're just making an estimate that somebody won't pay us. Okay?
So it's less specific?
It is, yeah, that's one way to look at it. It's less specific, or better, maybe a better way to say it is it's not specific to any individual customer or customers. Okay. So when we make our, under the allowance method, when we make our journal entry to estimate bad debt expense, the journal entry will be this entry. Bad debt expense will be debited, and allowance for doubtful accounts will be credited. Under the allowance method, that is the entry you make when you estimate bad debt expense. That's what's debited, that's what's credited. Now we're simply going to learn some different methods for coming up with the number that goes in that blank. Are you with me? Let's talk about the first method. The first method is a real easy one. It's called the percentage of sales method. And all we do is we take a percentage of sales. Let me show you how that works. It's best illustrated with an example. I can show you this little formula, but let's look at an example to be more clear. Barton has credit sales of $1.4 million in 2007. Management estimates that 0.5% of credit sales will eventually prove uncollectible. What is bad debt expense? Well, what is 0.5% of 1.4 million? Well, 0.5% of 1.4 million is 7,000. Now, if you punch that into your calculator, that's actually going to be 0.005. not 0.05. That would be 5%. This is 0.005 times 1.4 million equals 7,000. We calculate that amount, and boom, that is the amount that goes right in the journal entry. Okay? That is the amount that goes right over here into the journal entry. Are you with me?
Is that decimal written wrong then?
No. Going back, it's 0.5%, which is the same thing as 0.005. And they don't write it either any decimal way up here because they're using the percent, but when you punch it into your calculator.
Okay, yeah, I was reading that wrong. So.
Okay? Now what I want you to do is in your blue book, take a look at your blue book, and it's after those bank reconciliations. Can I borrow this for a second, Peter? I'll get back to you in a second. There is an exercise that looks like this, Mertz Company. What I want you to do is using the percentage of sales method, I want you to do that real quick. Okay? Want you to do that real quick. Okay? Mertz Company, everybody know what we're doing? You at home? Everybody, you do it as well. We'll see you in just a minute or two. It's pretty easy. Okay, let's go over that real quick. I forgot to bring my book, so can I use yours, Peter? Okay. Mertz Company had sales of 1.5 million. They used the percentage of sales method for estimating bad debt expense. If they estimate bad debt to be 3% of sales, prepare the journal entry to estimate bad debt expense. Well, we know that the journal entry will be a debit to bad debt expense and a credit to allowance for doubtful accounts, right? By the way, what type of account is allowance for doubtful accounts? Remind me?
Credit.
It's a credit, but what type of account? Contra asset. Okay, so we take 3% times 1.5 million, and what does that equal? 45,000. And boom, that's the number that goes right in that blank. So that is the answer. You with me? Did you get that? Boom. Now you'll understand why I emphasize that here in a second. Because the next method that we are going to do is the percentage of accounts receivable method. Now I think this slide is really confusing. Okay? So I don't want to dwell on it. I want to go to an example. I think it's best taught through an example. Take a look. Barton has $100,000 in accounts receivable, and they currently have a $900 credit balance in allowance for doubtful accounts on December 31 of 07. Now, past experience suggests that 4% of receivables are uncollectible. What is Barton's bad debt expense for 07? Now remember, guys, this is the percentage of accounts receivable method, not the percentage of sales method. Here's what we have to do. Engage your brain, really follow this. We take 4% times the 100,000, and that gives us $4,000. With me so far? Now listen to me. That is not, I repeat, that is not, one more time, I repeat, that $4,000 is not the amount that goes in that journal entry. We have a secondary step, taking a look at the PowerPoint. That $4,000 that we compute is the amount that we want to be the ending balance of allowance for doubtful accounts. However, we have a beginning balance already in there. We want our balance to be $4,000. It's currently $900 credit in allowance for doubtful accounts. So what entry do we have to make to bring the beginning balance to the desired ending balance? In this case, it's $3,100. Great question. Keeper asks, where do you get the beginning balance? Okay, let me ask you this. I'll ask you it one more time and I'll get to your answer. What type of account is allowance for doubtful accounts? It is a contra asset. When we close out accounts, do we close contra assets? No. So allowance for doubtful accounts will most likely and most often have a beginning balance that is a carryover from previous periods. Okay? Now, it's a great question. I can't fully answer it today, but you're going to see the different ways that the allowance for doubtful accounts can be debited or credited. Okay? Probably get to that next period. But suffice it to say, too, Keeper, this could have a beginning debit balance. It could have a beginning debit balance. Going to the screen, if this had a beginning debit balance of 900 on the debit side, do you see we would actually have to credit allowance for doubtful accounts for $4,900 to bring it to the $4,000. Do you see that? It's a great question, Keeper. Allowance for doubtful accounts will have a beginning balance. We need to figure out what we want the balance to be, and then this journal entry will be what we have to do to bring whatever beginning balance it is to this desired ending balance. There's another step in there as opposed to the percentage of sales method. You with me? All right. What I want you to do now then is on that same page, right under the Mertz Company example, I want you to do the Keatsman Incorporated example. Okay? On that same page in your blue book. Okay? Okay, but are we still rolling here, Dane? Good. Keeper asked, what if there's no beginning balance? Well, then in that rare situation, you would just say, well, then whatever you calculated would be the amount of the entry. But that is extremely, extremely rare. Okay? And I'm not going to try to trick you. Okay? There'll usually always be a beginning balance. Okay, let's do that Keatsman Incorporated example. Folks at home, do it as well. I'd like to get through that example. We'll go over the answer, and then we'll sign homework and we'll be done. But I want to get through at least the Keatsman example. Okay, let's go over that answer real quick. Looking at this in your blue book. Example 2, Keatsman Incorporated utilizes the percentage of AR method to estimate bad debt expense. If Keatsman has an AR balance of $3.4 million at year end and a credit balance of $6,200 in their allowance for doubtful accounts account, prepare the journal entry to estimate bad debt expense if they feel that 2% of AR will be uncollectible. Okay? Now, I always look, when they give that percentage, are they saying a percentage of receivable method, or are they saying a percentage of sales method? So you know which of these to shift into, right? Which of these methods. This is a percentage of AR. Okay? So let's go ahead and do this. Now we know that once again, this is going to be the entry, correct? This is simply a method for coming up with the number that goes in that blank. You with me? Okay. They want 2% times the AR amount of how much is AR? $3.4 million. What is 2% times $3.4 million? 68,000? 68,000. Now, is that the amount that goes in the blank? No, 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 it is not. What we have to do is we have to do a little T account for allowance for DA. What is the beginning balance of allowance for DA? 6,200, correct? Now we want a desired ending balance of 68,000 on the credit side, right? So our entry has to be for whatever brings that beginning balance of 6,200 to the ending balance, desired balance of 68,000. And in this case, what is that amount? 61,800. And that is what goes in the blank. Now this may appear a little bit confusing. It's not really that bad if you just realize that there's a percentage of sales method, there's a percentage of AR method. And the percentage of AR method, you have to do that little T account thing. Okay? This I guarantee will be on the test. Okay? And a lot of students, for some reason, never seem to get it. It's not that hard. You guys can do it. What I want you to do for homework, well, go ahead and do exercise 9-2 if you haven't done it. We didn't get to it today, and that's okay. We'll go through it next time. What I want you to do is if you go to that blue book, the examples that we just did, I want you to turn the page. I want you to do EBROM Company. I want you to do this full handout, that full page in the blue book. There's no page numbers. And then turn the page, and I also want you to do Chapter 9, Number 2, Fezzik's Place. And I want you to do this whole page. Okay? So just do those next 2 pages in the blue book. Awesome. We got through what I wanted to get through. We'll continue on this subject, but I want you to go home and get some practice. See ya.